Hello students. In my previous video, I have explained how to treat dividends and interest on securities in case of income from other sources. So today in this video, we shall see a sum exclusively for those two adjustments. Okay. So let us consider this as an example. Here they have given us 8 transactions with a note that says as to calculate taxable income from other sources for the assessment year 2019-20 of Mr. Narayan, an Indian resident. So that's what this information has been given to us. Okay, so the first transaction is rupees 72,000 10% tax free debentures of Mysore Municipal Corporation. So we have seen in our last video that any kind of tax free security has been given, then we need to gross it up irrespective of whether the investment amount and the rate of interest is given or the interest directly is given. Irrespective of that, we will have to gross it up if it is not a government security, right? Here Mysore Municipal Corporation is not a government company, right? It is not a government company, and hence any security issued by it will not be a government security, because municipal corporations are always local authorities and not a government company, right? So what we do is we need to gross it up. So how do we gross up? So let us start with the sum. See, so computation of taxable income from other sources. We have the assessee Mr. Narayan. His status, he is a resident. His previous year is 2018-19 because the assessment year is 2019-20. When 2019-20 is the assessment year, his previous year will be 2018-19. We have one particular column and an amount column. So the first thing is we record it. So what is it? It is interest on debentures, right? Interest on tax free debentures. So it is 72,000 into 10%. So what is the amount that we get? It is 7,200. Now we have to gross it up. So what is the formula for grossing up? In our previous video we have seen that gross interest is equals to net interest into 100 divided by 100 minus tax rate, where tax rate for securities is 10%. So here for this question, 72,000 into 100, because this is the net interest, into 100 divided by 100 minus 10. So 100 minus 10 is nothing but 90, which will give you amount as rupees 8,000. Okay, so this is the calculation that which we have done. Fine. Okay, so next, this is our first transaction completed. So next we have income from unit of UTI rupees 4,000. Any income received from an UTI is tax free in the hands of a shareholder, hence it is tax free, so we do not consider this amount at all. Fine. Dividend on equity shares from a domestic company rupees 12 lakh. So we have seen in our previous video that any dividend received on an equity share from a domestic company is always tax free, but in this case it is 12 lakh. So whenever there is an income received from a share of a dividend from a domestic company, it is tax free unless and until it is less than 10 lakh. But here it is more than 10 lakh. So when it is more than 10 lakh, the excess amount is taxable in the hands of a resident assessee. So here Mr. Narayan is a resident and is an assessee here, and his income from dividend of an equity shares from a domestic company is more than 10 lakh by 2 lakh rupees. Hence that 2 lakh rupee will be taxable. So what we do is we consider that dividend from domestic company. So 12 lakh rupees minus 10 lakh rupees. So whatever amount that we get is taxable. So it is 2 lakh rupee which is taxable, right? Okay. So the next question and next transaction is dividend received on preference shares rupees 10,000. They haven't mentioned whether it is a foreign company or it is a domestic company. When they don't mention anything in the question, we assume it to be a domestic company. So here domestic company and it is less than 10 lakh rupees, therefore it is not included in the as an income which is to be taxed. Okay, so that is excluded. Dividend received from cooperative society rupees 7,000. Dividend received from an Indian company domestic, I mean Indian company is always tax free when it is less than 10 lakh. But in case it is a corporate society, cooperative society or any other things, it is dividend is always taxable. Hence this 7,000 will be taxed. So dividend from cooperative society rupees 7,000 taxable. Fine. Next, dividend from a foreign company rupees 26,000. Domestic company is exempted, but foreign company dividend it is not exempted. Therefore, we consider that dividend from foreign company. What's the amount to be taxed? 26,000, right? Next, 2 lakh rupees 10% debentures of a public company. Okay, so here it is a public limited company, so and it is not listed. Irrespective of whether it is not listed or listed, the treatment will not vary, it will remain the same. So here it is the investment amount is given, the rate of interest is given of the security, and it is said that it is a public company, which means it's not a government company. So we will have to see it is a commercial security and TDS has been deducted and investment and rate of interest are given, then we are not supposed to gross it up. Okay, so whatever amount we calculate by multiplying with the percentage, that amount itself will go for taxing, right? If it was a tax free security, then we will have to, irrespective of whether the interest is given or investment and the rate of interest is given, we will have to gross it up. But here we need not gross it up. So whatever amount we get, that will be directly taxed. So here it is 2 lakh 10%, therefore it is interest on debentures. What's the amount? 2 lakh into 10 divided by 100, which will give you 20,000. So that amount will come in your amounts column, right? Okay, so next we have 3,600 received as interest on debentures of XYZ Limited. So here the interest amount is directly given and they have not said whether it is a tax free or tax securities. Irrespective of that, we will have to gross it up. Here we will consider it as less tax security and we will have to gross it up because the interest amount is given to us. Okay, as per our chart, if you are seeing, when it is a commercial security and it will always be TDS will be deducted, amount of interest is given, then the amount needs to be grossed up. So grossing up formula is always the same, that is gross interest is equals to net interest into 100 divided by 100 minus rate of interest, which is 10%. So here the interest amount is directly given to us. We take interest on debentures of XYZ Limited is how much? 3,600 into 100. This is net interest into 100 divided by 90. That is 100 minus 10. We will get 4,000 as our amount. This is our gross interest. Always only the gross amount will be considered in the amounts column. Okay. So any other in this thing is given? Transaction? No. All transactions have been recorded. So now we will have to total it. So total taxable income. How much is it? 8,000 plus 2 lakh plus 7,000 plus 26,000 plus 20,000 plus 4,000, which will give you 2,65,000. Right. So that is your total taxable income. This is how you solve a sum relating to income from other sources. This is just a transaction related to the interest on securities and dividend. So in the further videos we will understand the various other adjustments of income from other sources, and we'll also see the various sums related to that adjustments. Okay, if you have any doubts, do comment it in your comment section below. Thank you.